Okay, so welcome back to 529. Today is the very first really serious lecture on endogenous risk dynamics. And we might take a little bit longer today just to go through the whole model. But this is now a full model, still simplified. We will build on it further and further in the next lectures. But this is now a model with fire cells and all the bells and whistles we would like to have. Now, as I said, just a quick overview, we do real model. We did a simple real macro financial model, the Coco model, but there was only the experts could hold capital, physical capital. The households could not hold physical capital, so there was no fire sales possible. Now we will actually go to the endogenous risk dynamics where there be fire sales and the households can also hold some physical capital and they can also sell it back. Okay, so there's also after files you can sell it back. And then later on, we will move to models with jumps, potential sunspot jumps, bank runs, and all these things, sudden stops. So these jumps aspects we don't consider yet. And this is the real part of the course. And then we go to the nominal money part of the course later on. And if there's time, we do even do international models. Now, what we really want to have now, would like to have or want to have, is that we want to have a normal regime around the steady state, everything is stable. And then there is a crisis regime where things really fall apart, there are fire cells, amplification going on. And the normal state and around the steady state, experts are adequately capitalized and markets are self-stabilizing and shocks are absorbed very quickly. While away from the steady state, you have this endogenous risk, the price of risk moving up, fire cells, liquidity spirals, potentially fat tails are showing up. And there might be even some spillovers across agents. Here it will be less so because you have only two sectors, but you can think of spillovers across one sector, within one sector. And then we talk about how the SDF evolves and things like that. And also allude to the volatility paradox, which refers to a situation where when I reduce the fundamental volatility, actually the total volatility is not going down. Okay, so there's a paradox that, the whole economy fundamentally gets less volatile, but actually, the fundamental shocks are less volatile. The endogenous risk is actually going up, and hence the total risk is roughly staying the same. Okay, and you can also say, there might be some improvement in financial innovation, but because financial innovation allows some better risk sharing in certain types of risk, but it makes potentially the whole economy less stable. So these are the aspects we would like to capture today. And in terms of tools, I will teach you some new tools today. So the technological innovations you would like to learn today, I think, is that you would like to have some occasionally binding constraints. Okay, so there's some constraints occasionally binding. There will be a price setting planner setting. We will change the numeraire. I will show you that by changing numeraire, certain algebra will be much simpler. So that's in order for models where there's no aggregate risk, that's not a big deal. But with model with aggregate risk, it's actually very helpful. And I also teach you how to solve these models with the Newton method. But I will focus today on log utility specifications. So all the value function iterations, that will come later in the future lectures, okay? With log utility, we have seen before, the portfolio choice is essentially a myopic choice, and the consumption choice is just rho times the net worth. So we just use that and run with that. We don't have to do a value function iteration, okay? So we will do that. There's a lot to cover today already. So we do this in separate steps subsequently. Now here's the economy. It's a simple economy as in Coco. There's one extension. The extension is that this household sector can now hold physical capital as well. So we have the capital share of the experts is kappa E, and the capital share of the households is kappa H. And kappa E plus kappa H adds up to 1. And the other assumption, which is very natural, is that you cannot go short physical capital, okay? You can go short financial claims, but you cannot short a machine. What does it mean to short a machine? You can have some financial claims on the output of the machine and go short of these claims or some equity shares or some bonds, you can go short, which is like, borrowing money, but you cannot short some physical assets. So that's the assumption we make here. The other assumption we make, what we did so far, is the productivity of the experts is higher than the productivity of the households. Okay, so the A, think of the TFP of the experts is higher than of the households. Implicitly in the Basel Cocoa, we said, the productivity of the households is infinitely low. That's why they don't want to hold any capital. They destroy the capital once you give it to them, so that they don't touch it. Okay, here they can still produce something. The households have also some AH. They can produce something, but they're not as productive as the experts. Okay, and you can also think about the fraction of aggregate risk, which is held by the experts. I introduced the notation today, but in this model, it is the case that the experts can only sell off loans. So these are real loans, so there's no risk they can sell off. If they could sell off some outside equity, which we will do next time, let's suppose they could sell some of the equity stakes, let's say 60% of the risk can be sold off, then the risk share of the experts would be smaller. Okay, here we Chi, we denote the volatility of the net worth of the experts relative to the volatility of all the physical capital outstanding. So Q is the price of a machine, capital K is the number of all machines in the economy. So that's what we refer to as Chi. For today's lecture, we will assume they cannot sell off any outside equity. Okay, they can only sell off debt, like in Basel Cocoa. The only difference is that the households can now hold some equity. I can hold some physical capital. Hence, there could be fire sales going on. Okay? And then I teach you all the tools, how to do that. And the next lecture, we will actually enlarge the whole financing arm, where you can actually then also sell some outside equity. You might have more leverage constraints and other things which allow for more richer finance setting. Okay. So here, in the sense, we're coming back to this slide. What we have today, we have only incubate markets. So there's a natural hedging. So you can only sell off some debt claim. So you can buy some debt claim, you can sell off some debt claim, go short some debt claim. You have to live along this line. Even though of course, we have not only two states, we have a Brownian, which spans the probability space, but you can only trade the bonds. Okay. That's essentially what we had this slide before. So next time we will introduce also some leverage constraint. You can only sell off the bonds up to a certain leverage constraint. And we might also allow to sell off some equity claim. So the line is 45 degrees because it just means in state one, when state one occurs, the payoff is $1 in each state of the world. So a bond pays off $1 independent what state of the world realizes. Okay, so it's here the only two states. So if you're in this state, so in state one you get $1, in state two you get $1. If you get $3, if you buy 3 bonds, you get. So this is as you walk along this line, you buy more and more bonds, but in each state of the world you get the same amount. Okay, this is the payoff of the bond. It's a payoff space here. Okay. So, but you cannot buy an asset where you get, $3 in state one and 0 in state two. That's not feasible. Okay. Now here's the model in more mathematical terms. We have, as I said, 2 productivity levels. Experts have a certain productivity AE, and the households have a productivity level AH. That's, and experts are more productive than households. And so why is it important that households can hold capital, physical capital, is to capture fire sales, for households to speculate, or to obtain a stationary distribution. Should I give you the answer? I think it's A and B, in a sense that, if the households cannot hold any physical capital, you cannot fire sell to them. Okay. And to what extent do households speculate? They speculate in the sense that when the economy is down and the experts are undercapitalized, they hold the physical capital, hoping that the experts will become better off again and sell it back to them. Okay, so they speculate in the sense they don't want to hold the machines forever. They say, oh, I buy the machine and have to hold the machine forever and I'm less productive. They're willing to pay more for it because if the experts get positive shocks again and are well capitalized again, they will buy back the machine at a higher price subsequently. So they speculate because of this. When ether goes back, so the state variable wealth share of the expert goes back, and then actually the price will go up of the machine, and the households can sell it back to the experts. The experts are willing to buy it back. Okay. Now, then we have the investment rate that's the same as last time. The only difference is that now we have the households can also invest, but everything is kept the same way. So we will see in a minute that the investment rate for the households on the experts' investment rate is the same. They can also buy and sell among themselves. They can also sell, across the two sectors. So this deltas is not only within a sector now; it can also be across the sectors. Has to aggregate to zero, essentially. So all the D deltas have to aggregate to zero. So this should be actually small k. This should be a small k. So this one happens to be a typo. So then we had these modeling tricks, how to obtain a station distribution. We can have some switching types. The agents can die and then will be born, like in OLG models or perpetual youth models in continuous time without a bequest motive. Or we can have different preferences, discount rates. So what modeling tricks to obtain a station distribution? Which one of the three? They're all three of them. It's not really a poll. We have to pick one, and we pick the one where the experts are less patient than the patients of the households. Okay. Perhaps I should have specified first this slide and then come with a poll question. And then, so the question then is, they can only issue risk-free debt, and that means the risk share you hold is equal to the capital share. Okay, so you have to hold all the risk in the economy essentially. Okay? If you hold more capital, so not all the risk. As if you hold more physical capital, you also hold the risk with it. Okay. If you fire sell an asset with some physical capital, you also fire sell the risk with it. It goes to the household sector. Okay. So risk and capital allocation is the same. Okay, that's the assumption here. If we had outside equity issuance, this linkage would break. You could still hold all the machines, but sell off some of the risk by issuing some risky capital claims. And the guy who buys this outside equity is holding now the risk, but not the machine. But we don't allow this yet in this framework. We do this next time. Okay, so now it's simpler. We don't have to solve this separately between chi and kappa. We just solve for one of them. Mostly we solve for the capital allocation. So who is holding the physical capital holds also the risk associated with the physical capital. It's not possible to hold the machine and not the risk. If whenever you have a machine, you also hold the risk. So that's the model setup. And then recall from the previous lecture when we did the Bassa-Coco model, this was, households couldn't hold any physical capital and also no outside equity. Then we had that the Q was flat, so independent what the wealth share or the net worth share of the experts were. So if the experts are undercapitalized, then the Q is not going down. So how did the experts which had to held more leverage when they were poorer, the only way to compensate them to have a higher Sharpe ratio was to bring the risk-free rate down. Okay, it was not the case that the asset price was depressed or the physical capital price was depressed, hoping it would grow back. No, it was only because the risk-free rate was collapsing. Okay, that was the result, and that actually we don't have any fire sales. And in the extreme way, a fire sale is actually easing up balance sheet capacity because I can get rid of my risk and sell it to the households. In Bassa-Coco, you couldn't get rid of the risk. You have to hold the risk as an expert. No household is buying it. So you need a high risk premium. And in order to generate this high risk premium, I really had to make the risk-free rate go down. Okay. And then we had also, because we had the same discount factor here, of course, this is not, there's a typo here too. I forgot it was 5%, I think. And that was then we had a positive drift all the time. So the eta would actually drift over there all the time, and it end up with eta equals 1 in the long run. Okay, the station distribution is just everything is at 1. Okay, so if we let the system run for thousands of years or millions of years, eta would be 1. It would start, even if you start at 0.2, it will converge at some point to 1. It will shock, of course, here it's very volatile, but over time it will actually go towards 1. Now, how does this picture change if we now allow for the households to potentially buy some physical capital? What's your guess? Do we still get the negative interest rate? Do we get still that Q is constant? Of course not, otherwise I wouldn't do it. And then of course what we do is we allow for different rows to make sure that we don't have we have a nice station distribution. So we make actually the households less patient, okay? Or the experts less patient. So the experts, they want to consume at a faster rate. So once we do that, you get this. So the experts, they have a preference discount rate of 6%. The households have a preference discount rate of 4%. And so they're also more productive. They have 0.11 productivity. The households have only a 3% productivity. And this is the fundamental volatility, the exogenous shock, and the adjustment cost is 10. Okay, just what we had before as well. Okay, so the volatility is also the same what we had before. Now this Q function looks quite different. It is, so remember, this was the Q function in the Basakoko. Now it looks like this. Now you would say, why is it not flat anymore? So there's a region where the experts hold 100% of the machines, the physical capital, which makes sense. No, the experts are more productive. They should hold the machines. Okay. But there's also a region where the experts don't hold 100% of the machines. That's the Kreis region when there are fire sales. And when there's fire sales, the more undercapitalized the experts are, the more the price is depressed. Okay. And now, this is a little bit, that might say, okay, why is this the case that the price is actually going down as the experts become more and more well capitalized beyond in the normal region? And that's because of these two different rows. Okay, so what happens if the experts become more and more well capitalized? They are the primary drivers of holding these things, and they're less patient. And if you're less patient, you don't value a long-lasting asset as much. Okay, and this downward thing just comes essentially from this preference discount rate. Okay, it's not something desirable. If you have a different model where they would die, the experts die and will be replaced with average person, expert or household, then you would still have a flat line here. This purely comes from this different preference rate. Okay. Now, what's also interesting is you have the volatility of the price. So this is the price itself. That's the volatility of the price. Of course, the eta is moving around, and as the eta moves around, the volatility of the price moves around. So here's a volatility here, and what you can see is that, and you see it from Ito's lemma, if Q is a function of eta here, so Q is a function of this eta. If eta moves around, Q is moving around. If Q is increasing, that means if eta moves up, Q is moving up, okay, because it's increasing. So if eta moves up, Q moves up. That's why the word sigma Q is positive, okay, in this region. So they move in the same direction. Here, if it's downward sloping, that comes from these different rows again. If eta moves up, then the experts become more dominant and they're less patient. Q moves down. So eta up, Q down, that it goes in the opposite direction. That's why the sigma Q is negative here. Okay. In the normal region. You can also derive actually then the stationary distribution, and you can also derive, how does eta is our state variable, like it was in Basakoko. How does the eta evolve? And there's a drift, and then there is a volatility. And here's a that's the arithmetic drift, okay, and the arithmetic volatility. And you can see that you know, when eta is very high, then the drift is negative. When eta is low, the drift is positive. So the system drifts back here when eta is high, and it drifts up here when eta is low. Okay. And there's a stochastic steady state. What's a stochastic steady state? A stochastic steady state is if people anticipate there will be shocks as it is specified, but it happens there was no shock, then we would just stay there. So if we start here and it happened there was no shock because we were lucky, then the system would just stay where it was before. It would not drift away because the drift is zero. Okay, at this point. That's a stochastic steady state. It's, you know, but of course, if it were shocked up, it would drift back. If it shocked down, it should drift back this way. But this would be if it were not, if no shock has occurred, of course, we anticipated a shock will occur either this way or that way, but then nothing has happened, no positive and no negative shock, then we would stay there. Okay. And you can see that here's the volatility. The volatility of eta is somewhat here, is okay, but it becomes in the crisis region, the volatility is higher. So it jumps around more here. It drifts back faster, but it also jumps around more. So the volatility is higher here. And there's a jump in the drift and also in the volatility whenever you go and switch into crisis region. Okay. Remember, this kink, the driver is actually this kink here. Okay. When you switch to the other region, you actually have these jumps here in the drift and also in the volatility. We will see that. Okay, so that's what we do. We go through, that's what a preview, and we want to derive that. So you should be able to derive that in this model. Okay, that's what we do in the remainder of the lecture. So we do the same 5 steps we did last time. Of course, last time many things simplified because in Basacoco a lot of complications were not there. But we follow the same steps. So for step 0 is we postulate the aggregates, price process, and obtain a return process. That's the same what we had before. Now there's nothing different from what we had before. It's the identical slide. This is individual capital evolution. Then they can buy and sell. They can also sell now across the sectors, but you know the notations is the same. Everything is the same, and we assume that the Q process follows an E2 process, so no jumps. You know, jumps come later in the lecture. And we also assume the SDF follows a process with certain drift, which turns out to minus the risk-free rate, and a certain volatility loading, which turns out to be minus the price of risk. Okay. Instead of having this mu xi and the sigma xi, which are called here, we plug in minus risk-free rate, and here minus price of risk. Yeah. We know that this is the case. Okay, so that's what we postulate, and then we go from the price process. We postulate a price process, we convert it in the return process, and it's the same slide as last time as well, where we say, okay, the return of holding some physical capital is just the dividend yield, and here is a difference. What's the difference here? Last time we just said, oh, the experts can hold some physical capital, and we had the A of the experts. Now it's if the experts hold the physical capital is A to the power of E, or not to the power, superscript E, and if the households, there's a different A. Okay, so this return of holding a capital, they get the same capital gains rate and all this. It's the same capital they can buy, but when they operate the machine, the experts get a higher dividend yield than the households, and that's a different A. And they might all potentially have a different IOTA, the investment rate. That's the output they can sell for the consumption market, and that's the dividend yield. And then we have the capital gains, the expected capital gains rate, which was, you know, Q times K. So it was the growth rate of K. That's drift of K, the drift of Q, and what is this term? The E2 term. If the co moves, it's a positive. If it moves in the opposite direction, it's a negative term. How Q and K co-move with each other. That's expected return, the whole thing, dividend yield, and expected capital gains rate. And then we have the volatility. You have the K shocked, so it's coming a shock from the exogenous sigma here, and then Q is also moving. So that's this sigma Q here, which we have postulated. We have to solve at the end. and that's it showing up here. And then we have an SDF process, and I just, we just did it in the previous slide, and we have, this is just potential. Our SDF is just expected discounted the marginal value function as you change the net worth of this agent I. So that's an SDF process for agent I. Okay, there will be two agents, essentially two representative agents, one expert agent and one household agent. And they have a superscript I because they're potentially different. Okay, the price of risk for the experts might be different from the price of risk for the households. Okay, even the risk-free rate could be different in theory, but not so much because they both can trade this, so they equalize in equilibrium. Okay. So in particular, that's correct. So if you have trading frictions for the bond market, then you have different risk-free rates, and it could also be different. So this is a real interest rate if you're in a nominal model, and then there's only a nominal bond, and there's inflation risk, and then the shadow risk-free rate might be different because we can't really trade the real bond. We can only trade the nominal bond, and then you can also have different risk-free rates. Okay, so this minus iota, why is this minus iota? That's like, because what you do is you have a machine, the machine produces some apples, and then you use some of the apples to plant new trees or new machines. So so what you actually get, let's say a machine produces 10 apples, and 2 apples you take away and plant to produce new machines. That's showing up here. And of course, it's not lost. You get the higher capital stock. So this iota is subtracted here from the dividend yield, but added then to the expected capital gains rate, because then the K will be higher, it grows. And there's the adjustment cost functions we always have is over there. Okay. Very good. So you should ask questions. It's always good to have questions. So here's now our picture. I think we had this picture before. There's physical asset allocation and there's risk allocation. In this setting, it will be the physical asset allocation is equal to the risk allocation. Okay, so that's an assumption. You cannot sell off risk separately from machines. Whenever you want to get rid of some risk, you have to sell off a machine. Okay, because you cannot issue some risky claims. You can only issue debt claims. But if you want to sell off some risk, you have to really sell off the physical machines. So the kappa can move now, can be between 0 and 1, depending how. If kappa is 1, 100% of the machines are held by the experts. If kappa is smaller than 1, then part of it machines are held by the households, and then the total output is actually at a lower rate. So this A is a function of the kappa allocation. And then the price of the machines also will determine what the iota is, how much the growth rate is minus depreciation of the capital stock. So the output is used for consumption or the investment rate, like what we just talked about, taking some of these consumption units and converting them into physical capital. That's an investment rate, iota, capturing that, and that leads to a higher capital stock. And of course, the risk itself also shocks the capital stock. And then how this will then change the evolution of the net worth. That depends how much we consume. If we consume a lot, if the experts consume a lot, the net worth is going down. And of course, if there's risk, it will also affect the net worth. If there's a negative shock, the net worth of the experts is going down. If there's a positive shock, it goes up. And of course, they will also earn a risk premium. If they earn a higher risk premium, their net worth is going up. And this depends on the price of risk. Remember, the risk premium is price of risk times risk. And the risk is exogenous risk plus endogenous risk. That's, part of this is K risk and part of this is price risk coming there. We didn't have this in Basel Cocoa because the price was always the same, so there was no price risk going on. Okay, so that's a picture. So we have done the first step, 0 was the same as before, nothing big, new. Now we go to the finance block. Okay, the finance block is essentially, let's take the consumption net worth ratio as given, treat it almost like an exogenous process, and let's take the SDF as given. And then let's do the real investment, goods market clearing condition, and then later we do the portfolio choice. And the real investment is not really different from what we had before. The only difference is that now this IOTA is not only chosen by the experts, the households can also produce new machines or new physical capital by taking output and converting into physical capital. So that's essentially what we have. So we have the same, the change in the return on capital as a function of IOTA. They maximize the same thing. And the households and the experts maximize the same thing. They have different A's, no? But otherwise, there's no superscript I on it. So the objective function, once you take the first order condition, the A doesn't really matter. So they have essentially the same problem. So economically, why does it not matter? Because the households can take some apples and convert them into physical capital and sell it to the physical capital market at the price of Q. No? And the experts have exactly the same technology. So they have the same technology converting output goods into capital goods. There's no difference between them. So it's the same first order condition for both experts and households. And so if they all have the same IOTA, then our aggregate capital stock is just evolving according to this thing. So it's the same IOTA now without superscript I. And it's just the adjustment cost minus delta times, and then we use, like last time, we use this specific for this adjustment cost function, capital phi, we use this adjustment cost function 1 over little phi log of little phi iota plus 1. And this gives us this formula, phi times iota. So this phi times iota is equal to Q minus 1. If the price of machines is higher, you convert more output goods into capital goods. If the price of machines is lower, remember the numeraire is the consumption numeraire, you convert fewer of these consumption goods into the physical goods. Then I have goods market clearing condition, which is just A as a function of kappa. Remember what is A? So I think this has to, I forgot to specify this before. Capital A as a function of kappa is kappa of the experts times the little a of the experts plus 1 minus kappa times A of the households. That's a weighted average of the TFP. If the experts hold 100% of the physical capital, it's just A experts. If it's a convex, otherwise it's a convex combination. This is the total output, which can be used for consumption. That's the total consumption demand, which is consumption by the experts and plus consumption by the households. Remember, this I is a label for the sector experts and household sector. And later we will have some I tilde when there's a little expert inside the expert sector. Okay, this is I tilde. But I without a tilde is just the whole sector. We have two sectors in this example. Now that's it. Now we do the portfolio choice. And the portfolio choice, we do martingale method. Okay. Next time we also do stochastic maximum principle method, stochastic maximum principle method as well. Let's just do martingale measure. So here's the portfolio choice. We say optimization with the martingale approach. Remember, this was our formula. The drift of any asset A is the risk-free rate plus the price of risk times the volatility of this asset A. Okay, this was an asset A, which was a self-refinancing trading strategy. So we can just use that. What is essentially this drift of physical capital is just the expected return of physical capital is this thing. We had this just done before, no? That was the dividend yield plus the capital gains rate. This was our eta term. That's the expected capital gains rate. That's a drift. The volatility term drops out because we only look at the expected value. Is equal to the risk-free rate. That's what the risk-free rate is. Plus the risk premium, which is the price of risk from the experts, times the risk, which is the risk coming from K, plus the risk coming from Q. Okay, because Q times K, there's a K risk and there's a Q risk. Okay. So the whole thing is, these are all relative to the probability space, which is just given by 1 Brownian. So that's the expert's capital choice. So they choose a portfolio share theta. The theta they choose on the debt, and 1 minus theta they choose on the physical capital. Yeah, so here I assume that the risk-free rate is the same across, knowing that the risk-free bond can be traded. So they equalize. I mean, I could write a little E here and a little H here, then, but I know already that's the case. So the question, the poll question is, where are the thetas? Are they in this far phi's or far sigmas, or are they in this drift somewhere? Do you have any guess? So I choose the optimal theta. So where do you think are the var sigmas? Oh, sorry, I gave the answer away. Where are the thetas? they're inside the var sigmas, no? Because the var sigma will be in the log utility. It's always the volatility of the net worth. The volatility of the net worth depends how much risk you load up. That's a theta, 1 minus theta, essentially. You hold more physical capital, you have more risk in your net worth. Okay, they're inside here. So this is a expert's capital choice, or let's say 1 minus theta choice. Theta is what you put in the risk-free bond, and the theta for the experts is negative, and 1 minus theta is then larger than 1, so the lever up. And the same choice is also the holds for the households. Okay. So what's the difference between the two? The households, they have a different A, they're less productive, so the dividend yield is different. And there's also something different. There's an inequality constraint, or not constraint, inequality instead of an equality. So why is that? Can you see some complementary slackness showing up? So essentially, there's also this: you can't go short an equity, short some physical capital. Okay, so this is your required return, expected return, or this is the actual expected return. This is a required expected return, and it could be that you don't get it. Okay, so you require a 10% return, but you only get 8%. Yeah, what happens? You don't hold any of these machines. Okay, on this physical capital. Okay, so this only has to hold in with equality if the experts or if the households also hold physical capital. So if kappa H is positive, okay, or meaning in other words, kappa E is strictly smaller than 1. Okay, so if the households hold physical capital, then if they hold it, it has to be that the actually expected return is equal to the required return. But if they hold 0 and they cannot go short physical capital, then it can very well be that the actually expected return you get in this economy is smaller than what they require. And that's why they hold 0. I mean, ideally, they would like to go short, but you cannot go short a physical machine or physical capital. Okay. So once we did this, then we can actually obtain the capital allocation and the risk allocation, which is the same in our setting, because there's no thing. We have some thetas, and then we can use capital market clearing to obtain then the kappas. Okay, the kappa is the same as the chi, so we also know the chi's. Yes, so you can always sell the machine, and also so the optimal consumption choice here. The only question is what the choice we're looking here is how many of physical machines you want to hold relative how many bonds you want to hold or go short. Okay, that's the trade-off. That's the only what the theta we're looking here. The consumption choice, we have a separate first order condition where we will solve this. We are from log utility, we just know you consume rho times your net worth. But here it's only the portfolio choice we're looking at. So that's why, we just use this martingale approach on this portfolio choice. For a consumption choice, we have the other condition holding. Okay. No, so that's one approach. One approach is essentially you say, okay, I look at the portfolio choice of all the agents, and then I aggregate it, use the capital market clearing, and from the capital market clearing, then I get the risk and capital allocation. So the kappas and the chi, which is risk allocation, which in this model is the same because there's no outside equity or no risky claims to be issued. Okay. There's a different approach, which we call the price-taking social planner approach, where instead of solving everything for the thetas, we solve directly for the kappas and the chi's. Okay. So let me show how this works. So here's a theorem, which you should read up in the lecture notes. So it's a social planner which takes prices as given. Okay, so it's not a social planner which internalizes pecuniary externalities and all this. So it takes totally prices given, and it chooses a physical capital allocation and a risk allocation. So in our model, it's the same. That coincides with the choices implied by all individuals' portfolio choices. So normally what you do is, like you say, everybody is maximizing the portfolios, then the capital markets clearing condition, then I get the risk and the capital allocation. Let me look at some price-taking social planner. I will specify what he maximizes in a minute. And this guy is just maximizing things, and out of this comes the optimal capital and the optimal. So I don't need to go to the portfolio choice. Okay. And the planner's what he optimizes, he maximizes the expected return on net worth. This is the global net worth as a function of the capital allocation minus the vector of price of risk. So this is the whole vector of price of risk across the agents times the volatility on the risk allocation. Okay, so it's a whole matrix in a sense. Okay. So that's what the social planner. So this is like an inner product. So it's like a sum of many things. More generally, in our setting, the chi is equal to kappa. So it's very simple. Subject to the financial frictions constraint. Okay, I denote this kappa and chi have to be related. In our example, kappa and chi is the same. Okay, it's a very simple. So I can just replace here this chi with a kappa, and that maximize only with kappa. Okay. So this is a little bit abstract. I will apply it to our setting. This holds more generally. If you want to solve very general models, you can always do a price-taking social planners thing. So that's a little bit conceptually, it's a little bit challenging. And so it relates to the Fisher separation theorem. Have you heard about the Fisher separation theorem? So the Fisher separation theorem says, you have these agents in the economy that maximize their own portfolio. I can also say I outsource it to somebody else, like some portfolio manager, and I give this portfolio manager some linear objective function. So this is a linear objective function. And then he will do it for me. I just have to give this guy, some SDF, my SDF at the equilibrium, and then he maximizes that. Okay. So let me go a little bit more and sketch a proof of this pricing social planner and the Fisher separation theorem. It's a little bit like I don't have it here. So think of in a classical model, very simple model. You have a production possibility frontier, and you have an indifference curve. And where the production possibility frontier touches the indifference curve, that's where you get the optimum. Okay. Now, instead of using the production possibility frontier, I use the tangent on the production possibility frontier. Now, where this tangent line touches the indifference curve is still the same point. Okay. So rather than using the production possibility frontier, I use the tangent line. That's what the Fisher separation theorem does. Okay, so I just have to endow this portfolio manager. I have to endow him with the right line to get to the same thing. Okay, I'll put it differently. Why is it called Fisher separation theorem? It's connected to Ivan Fisher. It's a delegated portfolio choice by a firm, and initially it was said it doesn't really matter whether the leverage is chosen by the firm or you as the owner of the firm chooses the leverage. Okay, so it's also, you can relate to the Monieri-Miller theorem as well. Okay, so but the more broadly, in essentially you say that if you give the CEO of a firm the right SDF, he will do the optimization for you. You don't have to give him the whole thing, you just give him the SDF. Okay. Okay. So essentially, if you now apply it to our setting, so each individual agent portfolio maximize is equivalent to maximizing the firm's problem. That's what we say. So you maximize this firm's problem minus this is the risk premium, or there's a price of risk times the risk premium, the return on the net worth of this, and this the return on the net worth of agent I is the portfolio share of asset J of agent I, and the return on this across all the assets this agent is holding. Okay, and that's essentially just the expected component and the surprise component, the loading on this Brownian in our example. And what you see here, this is essentially a linear objective function. So what you have is you have either a bang-bang solution, or it has to be in such a way that the price and the returns and the risk, so for example, this var sigmas, the risk premium adjusts in such a way that the firm is indifferent. Okay. So the line, the slope of the line has to adjust in such a way that the firm is indifferent, or could not be indifferent if you go bang to a corner solution, because there's some constraint is binding. Okay. So once you use this Fisher separation theorem, and then we do the aggregate weighting of the portfolio weights, then we can actually relate the thetas directly to the kappas and the kais. So including the theta constraints we had before. And in our setting, kappas and kais will be the same. Next time, it will be not the same. Okay. So let's do it for our setting with two types. So we only have experts and households. So we have the theta choice. They can choose how much physical capital they hold and how much debt they issue. So theta ED, so that's the theta of the debt, and the E is the experts, that's negative, they issue debt. No, it's a negative asset. And they hold physical capital. And they maximize, so what they maximize is this thing here, minus the price of risk. So it's not now the expert itself, the expert is delegating to somebody saying, okay, I give you this price of risk. I say, so it's not like the expert says, okay, let me maximize given my utility. I tell somebody, I give you my price of risk and you, portfolio manager, manage it for me, but I give you my equilibrium price of risk. Okay. And then the portfolio manager does it for me and will choose the same thing as I would have done. Okay, that's the way how to think about this Fisher separation theorem. So that's essentially what they do, and that's what the experts are doing, and that's what the households are doing as well. And they give potentially different prices of risk, no? Because they might have different prices of risk, but they're all delegated to some individual, to their own portfolio manager who take it as given this price of risk and maximize. Of course, in equilibrium, the price of risk has to be such that this is a linear objective function that define an interior solution. Otherwise, you end up in a corner solution. Okay. Again, the experts, they go short, so this theta ED for that is actually negative. So, and then what I do is I take the aggregate, the eta weighted sum of the experts and the households maximization problem. So I take what the experts well share times what they're doing plus the households well share and times what they're doing. And then I get this expression here. So I have the eta wealth share times the portfolio share of the experts in physical capital. That's the capital share now. Okay, so they have, each expert puts a theta E into physical capital, and then it times the portfolio share. So sometimes we use the notation 1 minus theta here. So theta is the bond share or the debt share, and 1 minus theta is here I have a superscript K for that. Okay. So each expert puts a theta EK into the physical capital. This is like value weighted. If they have more wealth, they put in total more, and then they get the return on that. And then I have the households to do the same thing. Just this is just. So the households have the same thing, and then you have this is for the physical capital, and then it is also for the debt. Okay, that's a zeta experts for the debt, and there's a zeta households for the debt, and then there's a wealth share on this going on, and then there's the question: why is this term 0? Is it because marginal benefits are equal to marginal cost? Is it due to marginal behavior? Marginal behavior, and is it because the debt is in zero net supply? Who is for A? Who is for B? Who is for C? Too simple. It's of course C. So all of these terms which are in zero net supply, so any financial claims which are in zero net supply typically drop out. So that makes the analysis simple. So this is actually, as I said, it's a price-taking social planner. It's not only the experts planner, it's a for both. It's a value total net worth. So it gets the experts return and also the households return. And then I also have to subtract the risk premium the experts want minus the risk premium what the households want. Okay. So I have this guy, the risk premium for the experts, times the price, that includes the price of risk, and risk premium for the households, which has the risk weight and the price of risk of the households. So that's what we are maximizing, but this term drops out. So in this example, only that is the thing. So it's the price of risk, the risk premium matter, of course, but the debt itself is dropping out. And if you have next time you have outside equity, outside equity is issued by the experts as well and is bought by the households, it also drops out because it's an asset for one, it's a liability for the other one. Right? So the one guy issues it and the other one buys it. So now if I put this together in our example where chi is equal to kappa E and chi H is equal to kappa H, and actually, I know the kappa H is 1 minus kappa E because if the experts have 80% and the households have 20%, and so I can put all this constraint on it, then the objective function becomes this expression here. So the pricing social planner is just the weighted average of the productivity, so kappa E times the productivity of experts plus kappa H, the productivity of households, minus iota again, because some of this is a capital take away, it's not part of the dividend yield. And that's the capital gains. So expect capital gain from the appreciation of that, minus the risk premium, which comes, it's an average between what the experts risk are holding and times the price of their price of risk, and what the households are holding times their price of risk on the total. And this is the risk on capital. Okay. So that's my objective function, and that's a linear objective function. I choose essentially kappa E, and you can see it's all linear in the kappa E. So and the chi E is essentially also kappa E because it's the same here, and chi H is 1 minus kappa E, so it's all linear. So the price of the risk adjusted such a way that actually, so it's either the case that this price of risks adjusts in such a way that you get an interior solution, Okay, that's typically what you get in certain things. Or it's a bang-bang solution, and then you're in a corner. Okay. So then we take the first order condition with respect to kappa E. So then you get it here. There's 1 minus kappa E. So you get this minus this guy here divided. There's no kappa in this expression. There's a kappa here, and there's a kappa here. No? This is this kappa E, and this is 1 minus kappa E here. So that shows up here, multiplied by the sigma of the return on capital, which is the exogenous risk, the K risk, and plus the Q risk. And this holds with equality if you're not in a corner. So if you're not in a corner, then this whole thing has to adjust. This bar sigmas have to adjust in such a way, or the sigma q's have to be adjusting in such a way that this holds with the equality. If you're in a corner, then this holds with an inequality. Okay. Now, the next slide shows a little bit. So I've shown you two approaches. One is to say we just derive optimal portfolio share using the martingale approach, and then we use the thetas from the optimal portfolio shares, use the thetas, aggregate the capital markets clearing condition, and from this we derive the kappas and the k's, or particularly kappas in ours. Or we go the price-taking social planners approach, where we essentially forget all the thetas, just take the subjective function of the price-taking social planner and solve for the kappa and the k's directly. So you can either be on the portfolio space on the thetas, or you can be near the capital allocation, risk allocation, the allocation space. So portfolio space or allocation space. One is you go in portfolio space and then walk your way towards the allocation space. The other one is you start immediately with the price-taking social planner and be in the allocation space. Capital and risk allocation. Okay. So when should you do what? Okay. So now I'm going beyond the model we have here. In this model, we have one risk, which is there's one Brownian. There's only one Brownian. So the risk allocation is one-dimensional. So there's a capital allocation and a risk allocation. It's very simple. But let's suppose you have a model with 10 Brownians. Then you would actually have a very complicated risk allocation, which agent is loading on which Brownian in 10-dimensional things. And let's suppose you only have a few assets traded. So the portfolio thing would be much simpler. So if the asset span, the asset space is very small compared to the risk space, okay, then you want to work more with the portfolio thing, okay, and then work your way through the other space. If you have, on the other hand, which is more often the case, that you have actually the risk space is spanned by few Brownians, in this example, one Brownian, but the assets, there are many complicated assets on this one-dimensional risk space, like there could be debt, there could be outed equity, and all this, and they're all loading on the same Brownian. Then it's actually better to work on this allocation space because it's driven by this one Brownian. Okay, so it's a smaller setting in this sense. So that's a little bit. That's what this slide likes to contrast a little. It's like an aside slide. When do you want to use what method out of the two approaches? If you have a very complicated risk space, too many dimensional risk space, you work more on the portfolio side, and in particular, if you have few assets to optimize over. But of course, if you have 20 assets and everybody's choosing among a portfolio among 20 assets, that's very complicated. And so if you have 20 assets and very few underlying risk factors, then you would like to work much more in the price-taking social planner. But both approaches you can use. You choose your favorite one. You can use either choose your portfolios and then take each sector's portfolio choice, aggregate it up in capital market clearing, and do this way. Or you can say, no, I like the social planner approach. I go with this efficient separation theorem, take the price-taking social planners perspective, and maximize directly on the allocation dimensions. Okay. And I don't go through the whole portfolio. Now, what makes it typically complicated is that the portfolio approach is a more mechanical, a more approach which typically we're used to. The pricing social planner is more a direct approach, just jumping through the hoops and just going directly to the things. When you have constraints on the portfolio space, you have to be clever to translate it, how to translate in the allocation space. Okay? And that is sometimes complicated, and that's sometimes, if you have a lot of constraints, you might also go the traditional way through the optimal portfolio choice and don't jump directly to the price taking social. But in our setting, we have pricing and social planner. We can directly go for the asset and risk allocation, which is the thing here in our setting. And essentially, there are two cases. So there's we have just described this. So there's, if you look at the eta space here, there will be some etas when the expert sector is undercapitalized, and then there will be fire sales. In this case, the capital share of the experts will be smaller than 100%, smaller than 1. If you're in this case, the experts are well capitalized, they hold 100% of the machines of the physical capital. Okay? And then we have kappa E equals 1, and the households hold 0 of the physical capital because the experts are more productive, they hold it, they're happy to hold it, and the households are not willing to hold it. Now, there's a complementary slackness condition. So on the risk premium, the difference in the risk premiums, remember the difference they get in the dividend yield is this, in the experts and the households, and the difference in the risk premium is given by that. So if the households have to hold some physical machines, they essentially have to get the same risk premium, okay? But the risk premium, so that they get a lower dividend yield, so they also have to have a lower price of risk. Okay? So the households, when they hold a machine, they don't get the same dividend as the experts, they're not as productive. So that's why, in this case, there has to be the case that the price of risk is also lower. Why could their price of risk be lower? Because they don't take so much risk. Remember, the price of risk in the log utility specification is just the volatility of your net worth. And it is, of course, the volatility of the households doesn't need to be as high as the volatility of the experts. The experts are levered up, the households are not. And that's why the price of risk is lower, and then they're also happy to hold it. Now, if they don't hold anything, it could be the risk premium holds within it. This is inequality. It's a complementary slackness. So if this constraint binds, which means they cannot go short. So I'll put it differently. This is kappa E equals 1, which means kappa A equal to 0. They would like to go short, but it can't go short a physical machine. Then this holds with inequality as well. So one of them holds with inequality, the other one holds with inequality. And for high eta values, it will be the case. The houses are short sale constrained, they cannot go short physical capital. So, and for low eta values, there will be fire sales, so kappa E is smaller than 1. Okay. So that's the finance block. For the price taking social planner, we have learned this efficient separation theorem, and then we can see what is the kappa. And we use this later, and we put all of these equations together. Now, the next toolbox I will do, which I put still in the finance block, we will use it actually for the second step a lot, but I just want to show you what the change of Numeria does. Okay, and and the Numeria, I want to change it too. So far, we played with the consumption Numeria. Okay, Numeria was 1 apple, but now I want to change the mindset. I want to say, okay, let's use a different Numeria. And the Numeria we will use in these models often, it will be much simpler to handle models with aggregate risk, is the total wealth Numeria. So that means holding the total economy, the total economy, total wealth in the economy is our Numeria. So now, what fraction of the economy do you have? Okay. So everything is a fraction of total wealth in the economy. Yeah. Now, before I do this, let me just give a simple example of what does change of Numeria mean. And it's also a very powerful result of continuous time, because you can change Numeria very easily. And I want to show this change of numerator just saying, okay, I have a self-financing trading strategy, a payover of the value of a self-financing trading strategy or an asset in dollars. And then I give you another stochastic process, Y, which is an exchange rate between euros and dollars. So this is the euros in dollars that has a certain drift and a certain volatility loading on the same Brownian. So that's my exchange rate. And then what I do is the value in dollars divided by the exchange rate is then, I would like to, this is now the value of a self-financing trading strategy in euros, okay? So that's essentially what I want to do. So I just want to know what is this guy here, okay? And I can just, what do I do? How do I obtain that? It's just Ito's quotation rule. Remember that one? So we did Ito's lemma a lot. We are all familiar with that. We did Ito's product rule and Ito's quotation rule. We did also when we calculated the drift of eta, but here we can use it again. Of course, I could have written this the other way around, and it would be product rule again. But it's Ito's quotation. So remember, if I take the difference, this was the price taking social, forget, erase. This was the marginal condition, the expected return of self-financing asset of asset A minus the expected return of self-financing trading strategy B was the difference in volatilities times minus the stochastic discount factor. This was also our VAR sigma. That's we often call VAR sigma. Now, I want to express everything. So this is all expressed in dollars. I want to express it in euros. So I want this term here. So difference in drift in euros. And also this I want to express also in euros. Okay? This is sorry, not in dollars. In our setting was always consumption, was apples. Think of apples and dollars equivalent. So I have this, and so I have to express this in so to replace this, if I have this quotation rule, remember this was, if I have this, it was sigma A minus sigma Y. Okay, that's this guy here. And if I do XB over YT, is sigma B minus sigma Y. So that's this guy here. So if you look at that, I can just replace that. See how beautiful this quotation rule makes everything. But if you just see, these two guys just cancel each other. So the risk is actually not changing at all. It's the same as before. Okay, whether I express the risk in dollars or in euros. Okay, do you have an intuition why this is the case? Any intuition? Yes, but it's not only it's a change in units, but the units is stochastically moving around. It's not like moving from Celsius to Fahrenheit, where it would be constant. It's all the exchange rate is moving to. I think there's one. Of course, what you have to keep in mind is that the volatility measures in our setting, they're all geometric Brownian things, so they're always percentages. So it's a percentage change in dollars is also a percentage change in euros, because everything is in percentages. These are all geometric Brownian notations. Okay. So it comes from the geometric Brownian notations. Now, the important thing is, so if something goes up 50% in dollars, it also goes up 50% in euros. Okay. So, but the important thing is the price of risk is changing. So I have to multiply too. So if I look at the SDF, so that's my SDF now here, and I times XA. So, and then I multiply it by Y and divide it by y. There should be a superscript a here as well. Oh, sorry, there should be no superscript a here. This actually has to go. And so essentially what I do is I multiply by that. So that's why there is this additional sigma y showing. Okay. So I have this, the old sigma xc minus, so minus sigma xc minus sigma y, because I have this additional y now showing up by just considering x over y instead of x. Right? This is divided by y, and I have to multiply by, I don't have the same thing. And that's the price of risk exchange. So what's happening is that, so the risk itself, by changing the numerator, the risk itself is not changing. Or I should say, the risk is changing, but the relative risk of asset A versus asset B is not changing. But the price of risk is changing. So the price of risk in euros is the price of risk in dollars minus the exchange rate volatility loading on the same brown. There's always one brown. So that's the pole number 5, which we just answered already. Okay, that's the finance block. We are equipped with all the tools, and now we have to get the evolution for the forward equation. So we have the finance block that's now completed, and then we do the forward equation of eta. Again, that's the wealth share of the experts, how it moves forwards over time as they return more earnings or as they consume more, eta goes down. And then later on we do then going from the future backward to the present. That's the value function things. But because of log utility, that block will be very simple because we are solving now big problems. So here, that's the slide we had before. Equilibrium is a map from history of shocks into the prices, the price of risks, the iota, and the portfolio shares. All of these things will be a function of eta. We look at Markov equilibrium. So these are all just for same as we had before. Now, to get the evolution of eta, there are two methods. One method is what we did last time. Okay, so one method is using we have eta, which is the net worth of the experts, let's say. So eta of the experts, I is experts, let's say, divided by total wealth in the economy. So we do the following. We characterize the net worth dynamics of the experts. So that's given here. So we get what is this? So you get some return on the risk-free bond, on the risk-free real bond. And then you get some risk premium. So what's the risk premium here? It's the risk you're holding times this chi is your risk you put on it, which is the same as kappa in our setting, over eta. So that's if you lever up, if you hold more risks than your wealth share, then you get some risk you're bearing times the price of risk. So you get this risk premium for the experts, and then exposed to the risk. That's DZ. And then there's another drift term, which is if you consume more, the net worth is going down. Okay? So that's the evolution of net worth. So that's one thing. Then I have my evolution of Qs. It's postulated. Remember, there was the postulated E2 process for Q. And then we have the evolution of K. That was, but this was this phi of iota minus delta, and then we had the evolution of this too. So we first do the product rule. We did many times of these two guys, and then we do a quotation rule of these two guys, and you solve a lot of algebra. Okay, everything in consumption numeraire. You can do it in the network numeraire, total network numeraire as well. And that's one way to do it. And that's essentially, I won't show you all the algebra. That's for you at home to work through because you like to do lots of algebra. Now, an alternative thing is you say, I always make algebra mistakes. I would like to have a cleverer way to avoid algebra. And that's the second way. That's the next. You change the numeraire. What happens if you change the numeraire to the total wealth in the economy? Does anything jump at you? If the total wealth is the numeraire, then a portfolio share
is a wealth share. And so the whole Marticle method, which we used for the portfolio shares, now we did the Marticle method for the portfolio shares, it might also work for the wealth shares. Okay, because I just asked myself, what share of the total net worth numeraire is is the wealth share, and that's just eta. So what was n now? That's in consumption numeraire. If the numeraire is the total wealth in the economy, this becomes eta. In the net worth numeraire, loosely speaking, the net worth of the expert sector in the total net worth numeraire and the total wealth in the economy numeraire is eta. Okay. And that's what I'm after anyway. Okay. And I can also then apply the Marticle approach to value this portfolio share, or this, how much is the value of the whole expert's wealth? And it has to follow a Marticle. Okay. I use the same trick as I use for my portfolio optimization. Okay. And with this, I can actually then get from this, I can get the trick. Remember this Marticle approach, it was always, has to follow a martingale, corrected for the self-financing thing, so the consumption I have to take into account. But that has to follow a martingale. I use the same trick, and then I get the drift of this eta, which is the wealth share or net worth share in the total net worth numeraire. Okay. The trick does not work because the Marticle method is only for the drift. It does not work for the volatility. For the volatility, I still have to use this ratio rule for these guys here. But that's simpler because the ratio for the volatility term is just the difference of the two volatilities. Okay. It's just the eta term and all this stuff, which plays a lot of the algebra. So that's let me just show you this numeraire change and how it works in this setting. So the new numeraire is the total net worth in the whole economy, and we call this N, which, like in this example, is Q times K, so capital K, total value of all the machines. And the type I portfolio net worth is a net worth share. So if you think what's a portfolio, I take the portfolio of all the experts, that's the net worth share. Then if I use this number. And then I can use the Marticle approach with this new numeraire. So an asset A, it's I's portfolio return in terms of total net worth. So what do I get? I get the drift, and I do this self-financing. I reinvest the consumption. I get the consumption out of that. That's why I have to reinvest. I get the consumption out. I have to put it back in, and then I have the volatility. Forget this. Actually, this should not be there in this lecture. That's once we introduce idiosyncratic risk. So that's asset A, and for asset B, I use some benchmark asset. Let's say a risk-free bond. In our model, we have only a risk-free bond. Later, we will have some other assets. Let me call it for now. We call it some benchmark asset. Think of this risk-free asset, and there would be no DZ term either. And then I apply this formula. This is our formula we always use. Okay, just for this thing here. So I take, this is my drift minus the drift of this guy here. That's this, the thing here. The difference with the risk. So if I take a truly risky asset, the drift of sigma b would be 0. Otherwise, it would be this guy showing up here. Okay. So once I plug this in, I get this thing. I take any benchmark asset. It can be a risky benchmark asset. If it's a risk-free asset, then real risk-free asset, this would go away. And I'm in a different numeraire. Why is this a sigma n here? Remember, we said if you switch the numeraire, the price of risk is now different. Okay, this was this. If we're switching from dollars to euros, the price of risk I had to adjust. Okay, that's this time here because now I take it in terms not on the consumption numeraire, but in terms of total net worth numeraire, and total net worth is volatility. So the price of risk I have to subtract the volatility of the total net worth. So that's the drift of the eta portfolio share. That's the drift of the benchmark asset. The risk rate later it will be. And then this holds for all agents or for all sectors. Okay, it holds for each sector in the economy. And so I have this for the expert sector and the household sector in our example. So I sum this up, and then this, what happens from here to here, the i's go away because I sum up all the consumption net worth ratio. I sum them up in a weighted fashion, and this stays the same as I sum it up with the weights, and then I have a summation sign over this thing. Okay. And so the benchmark asset can be any asset everybody can trade. So what's important, we take a benchmark asset everybody can trade. So we cannot take the physical capital, or we can take the physical capital, we cannot trade an asset which only some can trade. Typically the risk-free asset, in our example, everybody can trade. So it can be the risk-free asset, so the sigma M would be. Why is it not 0? Yes. So if I take the risk-free rate, so, oh, sorry, it's written here. Because we have a stationary distribution, is this the case? Who is voting for A? Because the etas sum up to 1. Oh, sorry, this one. Forget the poll. The poll is referring to this question here. Why is this 0? Is it because we have a stationary distribution? You vote in 1 vote? Because the etas sum up to 1? 2, 3, 4. Because etas follow a martingale. You also vote for 1? Nobody votes for D, nothing of the above. Who votes for D? Okay. Let me say. So this is the sum of the wealth shares. Okay. What is the sum of the wealth share of all wealth shares in the economy? 1. How much does this whole one, if I sum it up, what's the drift of 1? Second, louder. 0, because 1 just stays 1 all the time. It doesn't drift up or down. So that's why this, if I sum up all the drifts, they have to sum up to 1 in the net worth numerator, I mean in the wealth shares, because everything is now a wealth share. So this term drops out. Now, coming back to the other question, why is that the case that, you know, let's say the risk-free asset has not 0 risk? It has 0 risk in the consumption numerator. It's a risk-free real bond. There's no risk. But is it real? Is it risky in the net worth numerator? Yes, because let's suppose the economy does very well and the whole wealth shoots up. It's actually, you get a smaller fraction of the whole economy. And if the economy tanks, you get a larger fraction of the whole economy. And that's why you have to have this correcting force. So, and that's essentially just the total net worth volatility if it's the risk-free asset. Okay. Now, once we put this together, we can do this for 2 types too. So if there are, in our example, there are only 2 types. So everything is set up, it works in most generality. I don't teach you things which only work for this particular model. But, you know, with 2 types, this summation becomes this, it also becomes 0. And then we have, you know, for the 2 types, we have to do it for both types. The summation just becomes this, and we subtract from each other. And then we get this following dynamics of the net worth share. Okay. And you might say, oh, this is actually not very bad. So you can see, what does it depend on? The net worth, the drift of the expert's net worth depends on what risk they're holding, and that's essentially what the risk premium they're getting. Okay. Then it depends what the risk premium, what the households are getting. Okay. So if they get more risk premium than the households, then it drifts up. Okay, it makes sense. and it depends on the relative consumption. So that's the consumption of the experts. That's the consumption net worth ratio of the whole. If they consume on average more than the average consumption, then their wealth share is also moving around. Okay. So it makes economically a lot of sense. So that's also encouraging if you work a lot and then you find some equations, you know, that makes economic sense. And it turns out to be so attractive. Like here, it's essentially the risk premium showing up and 1 minus eta 0. And you have the risk premium of these guys showing. Okay. Just wondering why is 1 minus eta E and 1 minus eta E in both cases. I have to double check that. Don't have a good intuition for that. Because this comes from the eta H. And it comes from that. So I have it eta E here. So subtract this 1. But, yeah. Okay. Now I said this works very well for the drift of eta. I can use the marginal method and it saves you a lot of algebra. For the volatility, I still have to use the ethos quotation rule. So, but I only need the volatility terms. And if I have the ethos quotation rule, if I want the volatility of eta, like here, it's just the volatility of NE, the net worth of the experts, minus the volatility of the total net worth in the economy. So it's just this expression. And, you know, if having many sectors, not only 2, that's just the net worth of, there should be a superscript I here instead of subscript. So the net worth of this sector minus the net worth weighted of all the other sectors. Okay? And I can also write it this way. Now, if I go for the 2-type setting we have in our setting, it is the net worth volatility of the experts minus the net worth volatility of the households. So this 1 minus eta comes because there's also the experts inside here. So I take the experts out here, and so I get the 1 minus eta here. Now, if I have only 2 sectors, this is just the household sector. So I get this expression. Okay. Now, if I look at this, what is the volatility of? So I have the volatility of eta depends on the volatility of the net worth of the experts minus volatility of the households. I can express the volatility of the experts as the K volatility and the Q volatility, and how much they lever up. The chi was the number of risks they take, and eta is the wealth share. So the net worth share might be 20%, but the capital share or the risk share is 80%. Okay, so this is actually the leverage. It's a form of leverage ratio, or it's the risk divided by what the wealth share is. Okay, because they lever up, this is something larger than that. For the household, it's the other way around. Okay, so it's the risk share is chi H divided by net worth share eta H, and I can express it this way. Okay, so that's, you know, this follows directly also from ethos lemma. So how do I get this? I can say what is the net worth dynamics of the experts, look only at the volatility term, and then derive this from this. So then I plug this in, I get this expression. Okay, so I replace these 2 terms here, I get this expression. And then there comes another insight. If I take the net worth share of the experts plus the net worth share of that's the arithmetic volatility plus the arithmetic volatility, why is this 0? That's essentially you have the wealth share of the experts plus the wealth share of the households, that's 1. How volatile is that? 1 is a constant, so it's 0. Okay. And then I can just rearrange it, I get this expression. And then I can, you know, plug this in and think this should be sigma plus minus plus sigma q. No, I'm mistaken here. So I think this we have to double check. My recollection is that I replace this guy with this guy, and then solve for this, and then I get this. But I have replaced this guy. This is, I think, the sigma plus sigma q here. Okay. Okay, but once I know sigma eta E, I also know sigma eta H. It's just related this way. Okay, that's what is useful to know. Once I know the volatility of the wealth share of the experts, I also know the volatility of the wealth share of the households. Okay, so essentially, yes, so this should be changed here. This should be this formula. And so how do I get this thing here? Eto's lemma. So Q is a function of eta. I know there's a process for eta. What is the process for Q? Now I want, for Eto's lemma, I've always the arithmetic mean, but only interested in the volatility term. Just have to take derivative of this thing. And then I multiply by this because it's arithmetic volatility. And this goes to the other side. But I can rearrange it this way and then get this from strictly from Eto's lemma, just for the volatility the volatility term. Not the drift term, but just the Eto's term and all this thing. Just the simple volatility. Okay. Now, once I see this, I can actually plug in for this. So bring this eta here over there and plug this in here. Then I get the volatility of Q is this, which is like a price elasticity. No? It's like, how does Q change as eta changes in percentage terms? Okay, that's a price elasticity. So this is like a derivative divided by the slope of the second, and then this term comes from this element here. So if I write down the total volatility and I solve this, the total volatility in the setting is given by this expression. And if you look at this and stare at this, this is probably one of the most beautiful equations. Not the most beautiful, but one of the beautiful, very beautiful equations. So this essentially says it's the volatility divided by 1 minus something. If you think about something divided by something, 1 minus what jumps into your face? A series. It's like a geometric series, the sum of a geometric series. And when a series comes to your mind, you think of spirals. No? You just have something multiplied by another Q, multiplied, and it's like spiraling through. You know? So you see a spiral, you see a loss spiral. Okay. So there's a first round effect, a second round effect, third round effect, and it goes on. So that's what it does here. And it depends on the leverage ratio. Do you see the leverage ratio here? This is the risk you take on. This is how much wealth you have, how much equity you have. That's a little bit like debt level, okay? Or the debt in risk term. You go beyond your own wealth share. You hold more risk than you have your wealth share. That's how much you borrow in terms of, and then you divide it by what you have. So it's like a debt equity ratio in risk terms. Okay. And this is the price elasticity of this. So if Q is constant, like in Basta Cocoa, what happens to this term? 0. So then the whole thing is 0. So just sigma divided by 1. So sigma Q is 0. Okay. But if as eta goes down, Q goes down. So that's a positive term. So the slope is positive. Then it is the case that you subtract something and it blows up this sigma Q. Okay, you see? So it's the amplification. You see the loss spiral at work. Depends on the price impact elasticities. Okay. So it's the elasticity of Q with respect to eta, which causes the amplification. Okay? That's why it's called amplification formula. I should put a box around it because it's such a beautiful thing. Okay, but you will never get this in discrete time models. Here you get a nice formula, and you can see it. And later on, we will have this formula, and then we also have some disinflation spiral, and you can see the spirals directly in the formulas. They look at you, and you look back and smile. Okay. Oh, here's the point. Where is the spiral? Can you see the spiral? It's the sum of an infinite geometric series in Q prime. You see the spiral in Q prime. Since with a constant price, there's no spiral. Now back to the big picture. Now we have to do the value function thing. Okay. But here in the log world, we don't need it. We just know with log, rho times the net worth is what you want to consume. So consumption net worth ratio is just rho, the time discount rate. And what you invest, your portfolio choice is myopic. Okay? So it doesn't depend on any value function. Okay? So in particular, I should say that the price of risk is just the volatility of the net worth. So the price of risk of the experts is their net worth volatility, and the price of risk for the households is the net worth volatility of the households. And of course, the price of risk for the experts is higher because they are levered up, so they hold more risk, so the net worth is more volatile. Okay. So now, so that's all what I wanted to say to the value function. That's the back, but we have a separate lecture. Otherwise, we will do it till 7 tonight. And we might do, but still see some smiles, but some worries too. But let's go jump to the numerical model. So now that's it. We can just put things together and solve it. Okay. But we saw the beautiful spirals and all this amplification. Now, so let's go back. We had this slide before. This was this occasionally binding constraint. You know, that's going on. There's a case, and then there's the short cell constraint binding for the households. And we have this other formula, the complementary slackness. So we use this price treating social planner thing to solve for the kappa, which is equal to the chi in our setting. Okay, so we have this based on the difference on the risk premium, we can solve for this kappa. So for log utility, I said, so this came from the step 3. We have done it in the portfolio choice already. The log utility means the price of risk is just the volatility of your net worth. So the price of risk for the experts is the volatility of the net worth of the experts. The price of risk of the households is the volatility of the net worth of the households. With, you know, with constant relative risk aversion, it was gamma times the volatility of consumption. With log utility, what do we recall? With log utility, consumption is just rho times the net worth. So the volatility of net worth is also the volatility of consumption, and gamma is 1, so we just get that. Okay. So this thing here, we have this. And this we can then replace by this expression here. And how do we know that this is the case? So we just have to notice that sigma net worth minus sigma net worth of households is the same in the wealth share, the net worth share. Why? That's just changing the numeraire, and that's the same thing. We did this before. This is in the consumption numeraire. This you can think of net worth share in the total net worth numeraire. Okay, you can subtract in both cases the same thing, and so it's the same. Now then we notice that sigma eta e, we have calculated this before, and sigma eta h we got from this. Let me go back. We got from this sigma eta h is this expression here. So we know all of this. So now we put things together. And so once we put everything in, so this constraint becomes this thing here with complementary slackness. Okay. So there's I put this square in bracket, in red, just to make sure that you notice that there's this guy here, and there comes another from the other guys. It's squared here. Don't forget the square. Okay, that's one equation. So this solves for our kappa. Okay, so that's our kappa. Then we have the iota we did already. Remember, this was Tobin's Q. That's easy. And then we have this beautiful amplification slide, amplification thing. We use this too. We write it in this form. So it's just rearranging it. So that's kappa, we have a formula. Iota, we have a formula and all that. And then we have good market clearing condition. That's so we have the capital share, which is held by the experts. A is the productivity of the experts. 1 minus capital E is the capital share held by the households times the A of the households minus, that's times K is the total production of output goods, minus iota times K is what you use to for the capital as equal to consumption. And what is consumption? Consumption is Q times, oh sorry, it is rho times the net worth. So it's rho times the net worth of the household. So it's rho times Q times K times the wealth share of the experts. Okay, so there's wealth share of the experts showing up here. And that's essentially what, on the K I divide through. The capital K showing both sides, I can divide both sides. So it's Q times K, total wealth in the economy, times a fraction belongs to the experts, they consume at the rate rho E, and 1 minus eta is the wealth share of the households, they consume at the fraction, they consume at the rate rho H. That's total demand for consumption. And we have taken care of capital markets clearing by the price taking social planner approach, and risk-free debt market clearing is Walras law. So now that's it. So we only have this. Okay, I should probably put boxes around it. There's one box, there's another box, and I should put a box around this too. So let's put a box on this guy. That's it. So we have, actually, let's look at 4 static conditions. There should be 4. There's Tobin's Q condition. We have the planners, social planner pricing, social planners condition, the goods market clearing condition, put a capital G here. And the amplification equation. These are our 4 conditions. So the way we solve that, when eta is 0, what's special about eta equals 0? What happens if eta is 0? There are no experts. It's a one-sector economy. Markets are boring. The wealth share is always 0. And what's the value of a machine at that point? It's just the quotient growth formula, depending on what the productivity of the households have. So actually, I can solve for this Q of 0 very easily. Okay. And then I solve from that, and then I solve essentially for eta epsilon, or eta 1 grid point up, and then I get another Q, and then I solve another eta up, another grid point up, and I walk for eta equals 0, then I walk up. And I know when eta is 0, the experts are constrained. The experts are physically. I mean, it's kappa smaller than 1 ratio. And as eta goes up, I have to check always how long do I stay in this kappa equals smaller than 1 ratio. So the households hold some machines or some physical capital. So for a given Q, then I say, okay, let me take Q of eta, plug in the optimal investment and all these conditions here, so 1 into 3, and solve an ordinary differential equation. Okay, and at some point I will say, oh, this kappa goes to close to 1 and goes equal to 1. I said now I make it's a shape change. Okay, so when the kappa E is equal to 1, 2 no longer holds with an inequality. With an equality, it falls with an inequality, and then I solve 1 and 3 for the QE. Okay. So 2 is not informative anymore because it holds with inequality, and then it goes solve 1 and 3, and also of course I use the 4 and 1. So that's essentially how I go step by step. So how do I solve this? And for this I use the Newton method, or we use the Newton method, and here just illustrated. So you can think of, I have these conditions. So these are the conditions I have, depending which regime I am. It's like multiple conditions lined up, okay? In an abstract way, I can think of, I have multiple conditions equal to 0, and that's what I have to solve for. And for this, I have to find the root of this multiple functions, of this multiple equation. And how do I solve for these roots? Let me illustrate. I'd use this Newton method. Let me just illustrate as if there were only one condition. Then I would say, okay, I'm sitting here. So how do I find the root, which is this point here? So what I do is I look at the derivative, and I say, okay, looking at this derivative, I go down here and I find this point as my approximation of the root. Okay. I said, oh my God, I'm closer to the root, but I'm not at the root yet. So when I calculate it, I get still, it's not equal to 0. But then I take a derivative on this point, and then I get this point. And then I walk through and I get close to this root ultimately. Okay. Now, instead of taking this derivative, if there are multiple equations, I have to take the Jacobian matrix. Okay. So it's the whole Jacobian matrix, which might invert it. And then I get, from this root, and this first approximation, then I get second approximation, and so forth. And I use this several iterating steps in order to get this root here. Okay. So that's the Newton method, how to find the root of a system of equations. So what's our system of equations? So we have the Gutzbach-Gering condition. We have this thing. So where it's red here, replace the red terms with the Tobin's Q things or the Planner's kappa E condition. So just replace these other conditions I gave you beforehand. And then, so at each point in time, each point for each eta, you solve then this. You have the Gutzbach condition is given this, equals to 0. You have the amplification equation equal to 0. I have this Planner's social Planner's condition, this, and then I solve, and my set is just given this expression. Okay. And I solve for the root. And once I do that, I get then the Q. So I solve it here, and then I move up the grid points along this eta axis. And then as I go up, I solve this thing up, and at some point the kappa becomes 1. Then I switch this condition because condition 2 is not meaningful anymore. I switch it to the other condition, and then I switch to the condition kappa equals 1. And then it goes down here. Okay. So this solves my Q function. And I can, so how do I get the sigma Q? The sigma Q is just from Eto's lemma. Sigma Q is a function of eta. Once I know the eta, that just, I explained this in the beginning, this positive slope. So that's just giving the slope, that's just from the Eto's lemma. Get this expression. Now you can also derive then the volatility and the drift of eta. So you get this as well. So you get here a positive drift. Then there's a drop down here, get a negative drift here. Over there, there's still a positive drift here, and the stochastic steady state is going on. And here's the volatility. Now, this is for particular parameters. So here, rho E is 6% and rho H is 4%. Okay. I could have changed it to 6% and 2%. So households become more patient. And then what you see is actually the stochastic steady state is actually where you start the crisis region. So this dotted line here, or the dotted vertical line, is where the crisis region starts. Okay. And but if I change now this contract from 4% to 2%, it actually coincides with the stochastic steady state. Okay. And that's typically, you can do that. It happens in these parameters. The question is a little bit, can you actually move the stochastic steady state into here? Can you make these guys even more patient so that actually this would come here and the crisis region would start here, and then only this whole thing would. So the stochastic steady state would be somewhere in here. Yeah. The question is yes or no. So let me say it again. In our baseline approximation, the stochastic steady state was actually in the normal region and not in the crisis region. Okay. In this numerical thing, the stochastic steady state is exactly where the borderline is between the crisis region and the normal region. Could I also find some parameters where the stochastic steady state would be in the crisis region? Shaking heads. No. Yeah, you can't. But that's typically what the all traditional models like Kiyotaki-Moore and BGT assume. They assume you're in the crisis region, then you get a zero volatility, a zero MIT shock, zero probability MIT shock, and then see log linearize around that. But if you solve the whole model in a global fashion, you cannot actually get into that because the drift has to be zero. In the crisis region, it's very hard to get a drift of zero. Now you can now play around. Now you have the model, you have your toy, and you can play around with it as you wish. So, and you know, you play around this volatility paradox. I said, okay, let's suppose the volatility is 10%. That was our baseline model. I move it down to 1%. How is the volatility changing? So the black one is 10% volatility, and I cut it by 10x. That makes the volatility only be 1%. And you see, it doesn't really change the volatility of the eta, the well share. Of course, it's a different point at which the crisis region starts. It starts at a much lower eta if the fundamental volatility is lower, but the peak of the volatility is roughly the same. Okay, what's the intuition for that? So the intuition is that as fundamental volatility goes down, these experts layer up more, and hence the endogenous volatility, sigma Q volatility goes up. Okay, so the sigma goes down, but sigma Q goes up. The total volatility stays roughly the same. Okay, and you see there's the sigma Q here. Sigma Q is actually going up relative to, so the blue one has a much higher sigma Q, and that pushes the whole system to the same volatility. But you can see here, here in the black line, you see the stochastic steady state is in the normal region. In the blue one, the stochastic steady state is actually when at the borderline between the crisis and the border and the normal region, the crisis region, the normal region. You can also change the market liquidity. What does market liquidity mean? It's like if I have to sell the asset to the households, how productive are the households? Remember the experts, they had 0.11 productivity. Now the households had only a 3% productivity, so not 11% volatility affecting households. But now I make the households even less productive. What happens is that the price drops in much further. Okay, if they are way less productive, or this. Oh yes, so it drops to -3%, from +3% to -3% or to -9%. The less productive the households become. So what does minus mean? There, when they operate the machines, they destroy all of the machines. Not half, but 9% of it. And so, but they might still buy it and say, I destroy it, but I can sell it at a higher price. So what's happening is that the price has to go up farther. So the drift is higher of the eta. So the system drifts out earlier, and they're hoping to buy it here. And as it drifts, the system drifts back, they sell it at a higher price back to the experts. Okay. But the market liquidity means how deep is the market if the experts lose wealth, a wealth share, the price goes down, how much does the market give in? And that depends, of course, on the productivity of the households. But you can see how this changes the whole system. Nothing stays as before. In particular, the volatility of Q is changing very different. It becomes very different. Now, there's one more thing I want to do, and this is about the KFE. What is KFE? The Kolmogorov forward equation. And so I gave you all this, the volatility of eta, and I gave you the drift of eta, but I want to translate it. If you run the system for millions of years, how long will the system be at this eta levels? How long will it be at this? I give you how the drift moved and the volatility, but I want to give you a sense as I run the economy, how long will the system be at this eta value versus that eta value? Okay. And for this, I need the Kolmogorov-Forward equation. It translates the drift and the volatilities in the stationary distribution. Okay. I mean, it does it more, but essentially going back, so I have this arithmetic drift and the stochastic steady state, and I have this arithmetic volatility, and I want to translate it into a stationary distribution. So how do I do that? So a Kolmogorov equation essentially characterizes how a distribution shifts over time. Okay, so we want to know there's a distribution of eta at time 0 that's initiated at this point. How does it shift over time? Okay, and of course it can shift over time if eta is. So how does distribution shift over time? So and for the Kolmogorov-Forward equation, we don't prove it, but I just tell you, and it seems natural. If so, there's a certain drift in eta, and it looks like an Ito formula. Okay, so it shines through in sense. So there's eta is time changes, so the drift is changing, and that's a change, the first thing. And then there is the Ito term here. Okay, so the second derivative, and then there's the volatility term showing up. Okay, so if as things change, of course, over time, eta is drifting back. If eta is drifting back, there will be more probability mass at higher eta values. Depending how this looks like. Now, this Kolmogorov-Forward equation in physics is often referred as Fokker-Planck equation. There's Max Planck, and I don't know if Fokker was his first name was. But in any case, if you have a station distribution, the distribution is not changing over time. So the change of the distribution over time is 0. So you put it equal to 0. And then you use, so we know this drift, we know this volatility. Okay, so we have to solve for this function here, knowing this drift and knowing this volatility. This is the arithmetic one. So we actually should specify that. Now that this is the arithmetic one. And so when we do this, then we can calculate the spatial distribution. And for our example, this looks like this. Okay, so if we run the system millions of years, it will spend some time in the crisis region. It will spend most of the time in the normal region. And I forgot now what the steady state was. Steady state was somewhere here, stochastic steady state. But the stochastic steady state is not the point where you spend most of the time. Oh, that's there. Okay. So is the constraint always binding or not just occasionally binding? What's your answer? It's only okay. Of course, the constraint is binding here. The short cell constraint is binding here, and here is, so it's occasionally binding constraint. And of course, whether you have a stationary distribution or not depends very much whether the experts have to consume at a faster rate than the households. Like otherwise, we end up like last week in Basa Coco, the system would be drifting to 1 all the time. And if the system drifts to 1 all the time, what's the stationary distribution then? It's a Dirac mass at 1. It's like you always move the system for the first 100 years. You have essentially eta smaller than 1, but then you drift to 1 at some point. You stay at 1, then forever. And then if you for the next 100 million years, you will be at 1. Spatial distribution captures how much time you spend somewhere. Okay, so that's essentially what the core ADC says. And what happens is the rules are the same. Experts take over the economy, eta goes to 1, and that's essentially what's going on. There's a steady state there. So that's the lecture 4. The lecture 4 covered a lot of ground. We essentially solved our model. We went away from this simple Basar-Coco to more where households can also hold capital. What did we not do? We didn't introduce a leverage constraint, so they could issue as much debt as they wanted. So it's not like in Kiyotaki Moore there's a leverage constraint. There was only for households here. It was a natural leverage constraint in the sense that the households find it too risky to hold on to the physical capital, and that's why some of that. We did not allow outside equity issuance, so the capital share was equal to the risk share. We can break this link. Okay. We assumed only log utility, so we didn't have to do value function iterations. Okay. We didn't allow for jumps, so no sudden stops and things like that. We have spirals and all this. That's fantastic. So there were a lot of things which we still want to switch on, and that will keep us busy for the next few lectures. But this was a core lecture to solve for the whole model. So the only thing which is really missing is, making the financial picture more rich. But methodologically, what's really new from now on will be the value function iteration once we go away from log utility. There will be there was an inner layer now, which was the Newton method, solving this root problem. And later on, we will have an outer layer where we solve for the value function iteration. So we propose a value function, solve the root problem, and then go back, modify the value function, solve the root problem. So there will be an inner loop which does the Newton method, the iteration in the Newton method, and then there will be an outer loop doing the value function iteration. But everything will happen in 3 seconds. So these models are easy to solve. It's not that it will take a lot of time. So thanks a lot, and thanks for holding out, and sorry for taking extra time today. But hope it was worth it.